Hello, everybody. Thank you so much for joining today. Uh, this is the fourth in an ongoing series of retirement webinars with the amazing Doug Carey, president of WealthTrace. I'm Alex Harmsen, the CEO and founder of PortfolioPilot. It's been a lot of fun doing this together. Doug, thank you so much for putting in all the hard work. You've made it a lot easier. So far, over just the last four webinars, we've had over 1,000 people, either attend live or watch the videos once they go up on YouTube. After the session, we'll send those out, and hopefully we'll see you in the next one. I'll pass it over to Doug, and Doug will explain what we're getting into today. Another fascinating topic. Hopefully helps you save a bit of money and feel a little bit more confident about retirement.
All right. Yeah. Thanks, Alex. So yeah, today we are going to talk about optimizing your withdrawal strategies, more specifically in retirement. My name is Doug Carey. As Alex said, I'm a chartered financial analyst, and I'm CEO and founder of WealthTrace. Some quick disclosure stuff. This presentation is for educational purposes only. Investment decisions involve risk, and you should not interpret any statements I make here today as a recommendation or an investment strategy. A little bit more about me. My name is Doug Carey. I am a chartered financial analyst. I was previously director of fixed income products at FactSet. I'm the CEO and founder of WealthTrace. And a little bit about WealthTrace. What does WealthTrace do? Well, it empowers individuals to build their own financial and retirement plans. You can have advisor level accuracy. You can link your investment accounts and view your holdings updated every day. And you can run powerful Monte Carlo simulations and other scenarios such as Roth conversions, withdrawal strategies, and asset allocation scenarios. And as Alex mentioned, this is in partnership with PortfolioPilot, which is your personal AI financial advisor. So who's this presentation for? Well, for a lot of people, because first off, it's for anybody who wants to try to minimize their taxes in retirement. So who doesn't want to do that? Those concerned about moving into higher tax brackets, but not just tax brackets. There are other brackets like Medicare premiums. You can jump into higher Medicare premiums if your income is too high. It's also for retirees trying to limit withdrawals from the retirement accounts. People with Roth accounts who aren't sure when to use them. This is actually a fairly large part of this presentation because there's a lot of confusion around when to use Roth IRAs and 401ks. And it's also for investors wondering when they should use taxable accounts that have capital gains embedded in them. So the agenda today, I want to start out by talking about general rules for withdrawals in retirement. There are a few of them. I will quickly discuss what a taxable account is versus a non-qualified versus a tax-deferred. I also want to spend some time on Roth accounts and explain why the best strategy is really plan specific. I wanted to discuss other important things about Roth accounts, like how you can leave it tax-free to heirs and the potential for long-term investing in a Roth account tax-free. We'll also talk about limiting capital gains and trying to also limit your Medicare premiums. And the way I really want to show all this, as I usually do, is through case studies. And at the end, I'll take questions. All right, some general rules for withdrawals. These are printed all over mainstream media, and you may have seen this in one form or another. So generally speaking, this is the starting point for a withdrawal strategy. Number one, take from your taxable accounts. Number two, take from your non-qualified accounts next, which non-qualified accounts, if you don't know, mainly means annuities that you can withdraw from and certain life insurance policies. Then take from your traditional tax-deferred retirement accounts. So these are your traditional IRAs and 401ks. So your withdrawals there are taxed. The entire withdrawal will be taxed at your income tax rate. And I'm assuming in everything today that you're not going to have a penalty for early withdrawals. Now, the general rule also is to take from your Roth accounts last. However, as you will see, this could move up to number 3 ahead of traditional retirement accounts. Let's talk about taxable accounts really quickly. What is this? What are taxable accounts? Well, bank accounts, money market accounts, taxable brokerage accounts. So in these accounts, it's generally lower taxes because selling your investments, even if you have capital gains, it can return part of your original investment, which is the cost basis, and you're not taxed on that. Long-term capital gains, the tax rates are usually lower than income tax rates. And also, the earnings on taxable accounts, dividends and interest, they've already been taxed. So if you use them to pay for spending, it doesn't trigger any new taxes, unlike a traditional retirement account. Also, by using your taxable accounts instead of your tax-deferred accounts, it allows you to continue to have that tax-free growth, which compounds over time. And the compounding of tax-free growth is extremely powerful. And if you watched one of the or two of the other webinars where I mentioned compounding, you saw just how powerful compounding of tax-free growth can be. Non-qualified accounts, as I mentioned, these are mainly annuities and forms of life insurance. How these work is the earnings and capital gains are taxed at your income tax rates, but the withdrawal of the cost basis is not. So it's kind of a hybrid of a taxable account and a typical tax-deferred retirement account. So, but the main thing is the growth is tax-deferred, which again allows it to compound more over time. Now, traditional retirement accounts, this is what most of us are used to. 401ks, traditional IRAs, where your contributions are pre-tax, so you get to deduct it from your income. But when you withdraw the money, that entire withdrawal is taxed at your income tax rate. Okay, so that means that when you withdraw the money, obviously that money does not continue to grow tax deferred. Also, withdrawals, because all of it is income, it's considered income, can push you into the higher tax brackets. Also, could push you into higher Medicare premiums. It could push you into higher capital gains tax brackets, and possibly all three at one time. Roth accounts. So a Roth account is where when you contributed the money, it was post-tax. So you got no tax deduction for it. However, the entire withdrawal is tax-free. So quite different than traditional retirement accounts. Now, the rule of thumb, when you read it in the financial media, is use Roth accounts last. I don't like this kind of rule of thumb that doesn't at least mention the fact that this is definitely not always true. So beware of rules of thumb in the financial media. Whether or not you want to take from a Roth before a traditional retirement account will depend on your tax rates and your life expectancy, amongst other things. Those are the two main things. And also, you need to decide how important it is to leave money tax-free to your heirs, because Roth accounts will never be taxed. Okay, so I mentioned I really wanted to talk about Roth accounts quite a bit. Let's look at a case study. So this case study I want to start out with it goes against conventional wisdom. Now, there are literally thousands of different scenarios I can run for withdrawal strategies. There's so many, but obviously time is limited. So I do want to focus on just a couple of cases that I have found to be the most prevalent with my customers. This is a big one. In this case study, you will see that using a Roth IRA sometimes is actually, in this case, this is conventional wisdom. Using a Roth last is best in this example we're going to go through. Okay, so here are the assumptions. A married couple, they're 55, they're planning on retiring in 5 years. They live in California, life expectancy of 85, annual expenses of $80,000. They have $500,000 in a Roth and $1.5 million in a traditional IRA. Their allocations split 75-25% between stocks and bonds. And to make sure we're comparing apples to apples, I have the Roth and the traditional IRAs in the same asset mix. Okay, so 75-25 split. Then they have Social Security combined of $40,000 a year. Now, I ran their retirement plan in WealthTrace. And when I ran their plan, I found that they will have about a little over $1.2 million left when they are 85 years old. So this is at the end of their life expectancy. All right. So this is the number I like to use. I'll get more into that in a little bit. Also, I want to mention the total taxes paid over their lifetime starting in retirement is about $574,000. So this is their total taxes. I just added it all up every year. Now, what if they use the Roth before traditional retirement accounts instead of after? Well, I found that they would have a little over, a little over 1.2 million. Sorry, I'm having trouble reading this. It's a little small on my screen. 1.28 million when they hit their life expectancy of 85 years old. So that's compared to, I think I misspoke, is 1.32 million before when they use a Roth last. So it went down. It went down when they used the Roth first, which is conventional wisdom, right? The conventional wisdom says use the Roth at the end, after traditional. Interestingly, the lifetime taxes paid here is only $380,000. So that's compared to $574,000 when using the Roth last. So this seems to not make sense because the taxes paid got better, so lower, but the ending investment values were worse. Well, I wanted to show this because my point here is that adding up total taxes paid isn't a good metric to use because it doesn't take into account all the timing of inflows and outflows and compounding. Only the ending investment value does. It takes into account all the timing aspects. So don't use total taxes paid. It's just not a good way to analyze this. Now let's look at a case study where using the Roth first before traditional retirement accounts is actually better. And this goes against conventional wisdom. So we have our similar client assumptions. I did change a few things, like annual expenses are higher. They're now $120,000 a year. They have slightly higher Social Security, now $60,000. And I added a pension, an annual pension of $75,000 a year because I wanted to increase their income tax rates. And that's really the crux of the matter here. When their income tax rates are higher, it can make sense to hold off on using their traditional retirement accounts. So I ran this again, and I found that if they use the Roth before traditional, they will have about $2.5 million when they're 85 years old. If they use the Roth after their traditional accounts, they only have 1.9 million. So that's compared to 2.5 million. So it went down quite a bit when they were using the Roth before traditional. So in this example, it makes sense, quite a bit of sense, to use the Roth account before the traditional, and that's just due to the higher income tax rates, right? It's better for this couple to hold off on paying those income taxes as long as possible because their income tax rates are higher. Here's just a quick summary of what I found. You can see that in the lower tax rate environment, that using the Roth last makes sense, and the difference was about $300,000 in the end of their plan value. But when their tax rates are higher, the ending plan difference, if they use the Roth first before traditional retirement accounts, it gave them about $600,000 more when they were at the end of their life expectancy. Okay, let's look at a case study of using taxable accounts when, in this first case study, using it after retirement accounts is actually best. Now, this doesn't happen that often. This is a little bit of an outlier, but it does happen sometimes. It happens when your income tax rates are pretty low and your capital gains tax rates are higher, right? That can happen. There's a small segment of income where your capital gains tax rates, especially before Social Security begins, can be higher than income tax rates. And that happens in this case here. So similar to the first case we looked at, except that I swapped out the Roth for a taxable account that has a cost basis of $200,000. So $500,000 in a taxable brokerage account, a cost basis of $200,000. What I found was at the end of their plan, if they use a taxable account first, which is again the conventional wisdom, they'd have a little over $1 million left. But if they used it last, they have 1.026. So almost $20,000 more. Not that much more, but it is a case where mathematically it does make sense for them to hold off on using the taxable account. Again, it's a little bit of an outlier, but it does happen. Now, here's the typical scenario when using a taxable account first is better. What I did was I added the pension back, so their income tax rates are a little bit higher. And sure enough, well, they are $250,000 worse off if they use their taxable account last. So in this case, what they want to do is follow the conventional wisdom and use the taxable account first because their income tax rates are just slightly higher. I wanted to briefly talk about tax efficient asset location as well, because it's related to how you're going to withdraw from your accounts. And basically, how you're going to withdraw can depend on where your assets are located and what your plan is for those assets. So, for example, taxable accounts, generally speaking, can be better for growth-oriented stocks and ETFs with lower dividend yields, because if you're having more capital gains, you can control when to sell those. So you can lock in your capital gains later at favorable rates, or simply never sell it. And if you pass it on to your heirs, well, the cost basis steps up and they might not owe any taxes on it. Traditional retirement accounts can be good for bond funds, REITs, higher dividend paying stocks. Dividends and interest would otherwise, it can generate an annual tax drag if it's in a taxable account instead of a retirement account. For Roth accounts, this can be a great spot for your highest growth investments. Now, this is something I harp on quite a bit. If you don't plan on withdrawing from your Roth accounts for a long time, or possibly ever, you have a great opportunity to take a little more risk. And the reason is your time horizon is longer, right? The time horizon is longer, it grows tax deferred, and whoever ends up with the Roth in the end will pay no taxes on it. So imagine allowing a tax-free Roth, so tax-free growth, tax deferred, tax-free, growing for 30 years at an average of 8% a year. That is a huge chunk at the end. And 20, 30 years is a long time. There's never been, over any 20-year period, even including depression, stocks have never delivered a negative return over that time frame. So if your time horizon is long enough and you're not going to touch the Roth account, it can make a lot of sense to take more of your risk there and less of your risk in your taxable accounts or even your traditional IRAs. So tax asset location really could be a whole webinar into itself, but I wanted to mention that because it is related to withdrawals. Now, I have a lot of customers who have a fear of jumping brackets. And so I like to talk about how to visualize this and how to look at it, at least in the WealthTrace software. Now, by brackets, I don't just mean income tax brackets. I'm talking about capital gains brackets. There's something called the net investor income tax, which is another 3.8% you might pay on capital gains and dividends if your income's too high. Then there are Medicare premiums, otherwise known as the income-related monthly adjustment amount, IRMAA. Those are all related to your income. And so all of those, you can jump up a bracket or brackets if your income increases. Now, WealthTrace, you can view this. Here's one example. This is where their income is increasing, and you can see the net investment income tax, which is a 3.8% surcharge on capital gains and dividends. If your income's high enough, it jumps up here, and you can visualize that in scenarios that you're running. Same thing with Medicare premiums. You can see it go up here. It can go all the way up to over $17,000 a year if your income is really high. So Roth conversions or taking a bunch of money out of an IRA at one time can really hammer you in terms of Medicare premiums. So it's really great to be able to see this data where you're jumping brackets, and it can stop you from potentially doing something silly like going just a few $1,000s over the limit. Maybe you can time out your spending a little bit better. So to summarize, there are some general rules for withdrawing, and most of them hold up most of the time, but not always. When using Roth IRA last, this is the one that is probably the most controversial, because if you have if your tax rates are not low enough, if they're lower, you want to use it last, but if they're not, you might want to use it before your traditional accounts. Also, what if you want to give it to your heirs tax-free? Well, that could change your mind too, and you might want to hold off on touching it altogether. Lifetime taxes paid is not a good measure to determine a withdrawal strategy. Don't use it. That's my opinion. I like to use the ending investment value because it takes into account all the timing and all the compounding of cash flows. Also, generally speaking, it makes sense to use your taxable accounts before everything else. If capital gains tax rates are higher, though, than income tax rates, you might want to use a taxable account later. This is an outlier scenario, but it does happen. So before I take questions, I just want to mention there's a 7-day free trial for WealthTrace. There's also a trial for PortfolioPilot, and you can get a discount. The discount codes are right here. You can get 25% off WealthTrace, and you can get 1 month free with the discount code here for PortfolioPilot. So I'm going to look at questions now. Will I be sharing the presentation? Well, I will. You will get a link to the webinar that's going to be shared later. How do you compare final state value if you end up with more funds than those? Yeah, so the question is basically, what about the fact that you end up with money, the Roth money that will be tax-free forever versus the traditional? The best way to do this is to be able to put in a longer time horizon so that you get the scenario where you can see the change over time if your heirs inherit the money. So that's something that we're going to put into WealthTrace, the ability to push that out so you can analyze it even after your life expectancy. Variable annuity account invested in quality low. Oh, I lost it. Oh, let me answer this one. How would the Roth withdrawal strategy change if husband has a shorter lifespan, expected lifespan? This is a good question that I hit on in the Roth webinar. This will show up in the scenarios if you change the life expectancy of one person. It will change the withdrawal strategy for sure, because what happens is when one person passes away much earlier, the other person is hit with what's called the widowers or widow tax when tax rates jump way up. So this would make a Roth much more valuable and it affects whether you should convert or not. It also will affect what you should withdraw from first, whether it's the Roth or the traditional. So it's really great to be able to run the scenario where life expectancy might be shorter for one person. Now, whether it means the Roth should be used first or last, well, if it pushes up your tax rates, you would probably want to use the Roth first before traditional if your tax rates are really high at that point. Someone asked if the withdrawal strategies that we were discussing here in WealthTrace or PortfolioPilot, these were all run in WealthTrace. What's my view of the 4% rule, and how does the tool help determine which assets should be drawn from first? I don't love the 4% rule. It's kind of a relic. It was created long ago. Interest rates were very different back then. There weren't powerful apps like there are today to run real scenarios where you can determine exactly how much you can spend without running out of money, and you can change your spending in various years. So I would much rather use a powerful planning tool. Now, how does the tool help determine which assets should be withdrawn from first? Well, WealthTrace, you can change the order easily. You just drag and drop. You can tell the program if you want to use a Roth first or last and rerun the scenario and just look at that ending value that I showed. Does it go up? Does it go down? That's a very quick indication of which scenarios are best. Okay. Where to change tax strategies in the software? Well, that's a broad question. I kind of mentioned how to change withdrawal strategies. By tax strategies, there are a lot of things you can do, such as change your contributions to different types of accounts, whether it's a Roth, traditional, or even a 529 plan, and you can view not only your ending value, investment value at your life expectancy, but whether there will be any cash shortfalls, right? Based on maybe you put too much into a 529 and not enough into a taxable account, and you're going to run into some shortfalls where you don't have enough money in other accounts you can spend. Okay, I think that's about it. I'm going to scroll through one more time here. Oh, here's one more good one. And then I'll end it here. If the majority of your portfolio is an IRA, does this push us toward tapping IRA first to lower RMDs and tax bracket problems down the road? So I've gotten this question quite a bit. Should you use your IRA first to lower your RMDs later to avoid being pushed in the higher tax brackets and paying a lot of taxes on your required minimum distributions? Well, possibly, but if you're going to do that, generally, you might as well just convert it to a Roth, right? So if it does make sense to use up the IRA money first, you might as well, in most cases, just go ahead and convert it to a Roth, and that way it will at least grow tax deferred and tax free instead of taking it out and throwing it into a taxable account. Okay, so I think I'll end it there. Thanks everybody for attending. And yes, we will make this presentation available later that you can watch on YouTube.